Good morning, everyone. My name is Eloise Hall, Head of National Accounts here at Kensington Mortgages, and welcome to our latest webinar and the last one of 2024. This morning, we'll be looking back over the last year that we've had in the mortgage industry and asking the question, will the market thrive in 2025? So before we get into the agenda of the day, I'll just run through some brief housekeeping tips. You will have the option to submit questions throughout our session today, and my expert colleague will be on hand behind the scenes answering those for you. If you do have any tech issues, please do use the same question box and we'll be on hand here to help. We are expecting to run to around 45 minutes this morning, and your CPD certificate will reflect this. They'll be emailed out to you after today's session, so keep an eye on your inbox for those. But to make sure I keep to time, let's get started with the day. So having a look at the agenda, we can see that first up, we'll be joined by Tim Bannister, property expert and Rightmove director, who'll be reviewing 2024 and giving his predictions for the year ahead. We'll then be moving on to our interview with the one and only Mark Arnold, Kensington CEO and Head of Life Moments at Barclays Bank UK. And lastly, I'll be giving you a Kensington business update with insights into what we're doing here at Kensington to continue our support of you, our intermediary partners. So without further ado, please let me welcome Tim Bannister, Director at Rightmove. Over to you now, Tim.
Great. Well, thank you, Eloise. So yes, I'm Tim, and in my role at Rightmove, I look at all the data that's flowing around Rightmove. That's the supply side data, that's the hundreds of thousands of properties added to the site, and the demand side of the data, that's the billions of minutes and the millions of email inquiries and so on, telephone inquiries that are sent through Rightmove on a monthly basis. And it's that data which I'm going to pull out and try and give you some insight from today. And really what I'm going to talk about is the market, what we've seen so far this year, and what we might expect to see in the coming year. So certainly from the point of view of the election, which was the big thing at the beginning of the year that we were talking about, we took a look at this and we thought, in previous elections, what had happened? So we were looking here at sold subject to contract, so SSTC, so properties going under offer, and what had happened following an announcement and then the election date itself, and then after the election in 2015, 2019, sort of comparable elections. And what we saw was that in the past, actually following an announcement, there wasn't a significant change in people's activity levels. It continued on trend in both 2015 and 2019. There was then actually a little bit of a bounce after it, as perhaps people then, with that uncertainty out of the way, just wanted to get on with things. And that sort of actually matched what people were telling us. We surveyed people at the beginning of the year. This is a very large survey of tens of thousands of people. And we asked them, what would would the election impact your decision making? And actually 95% of people said no. If we're planning to move, we're just going to get on with it. And that was very much sort of, I think, the theme of 2024. People have been following a stop-start year in 2023, and they just wanted to get on with moving this year. And so we've seen that in the SSTC numbers. So this is now showing you sold subject contract numbers indexed back to September 2019. So anything above 100% is more than September 2019. Anything below September 100% here is lower SSTC numbers than in September 2019 on a month-by-month basis. So that's what it looks like. You can see there, in May 2020, that big dip from COVID. We saw then the very, very fast active market of 2020, 2021, and into parts of 2022. We saw the dip in activity towards the end with the mini budget sort of impact and sort of rising interest rates and rising mortgage rates impact, and then that sort of stop-start 2023 that I mentioned. And then what we've seen actually in 2024 is activity level pick up with that desire to get on with things. I mean, actually, we saw perhaps as expected, based on what we've seen in the past other elections, we saw a bump up in SSTCs in July. When we normally see a dip, and we're currently running about 20 to 30% above where we were in 2019, where we were last year in terms of SSTCs, and a little above where we were in 2019. So we have seen activity levels pick up, and as I say, running significantly stronger than where they were last year. At the same time, though, we have been seeing stock levels building. So this is the available listings on Rightmove, and you can see that we're up about 12% compared to where we were a year ago. It's the highest level of stock roughly per agent since for about 10 years. So there is more stock on the market. It has been building from those very, very, very fast times of 2021, 2022, when stock was turning quickly and listings couldn't keep up with the demand, and that's why we saw sort of, an impact on price and so on. We have seen stock building, but at the same time, as you've seen just a moment ago, that stock is transacting. So say 20 to 30% more transactions than they were last year in terms of SSTCs. So more stock, and more choice, but more transactions occurring. It's worth bearing in mind with more stock there, that affordability remains a concern. So there's more choice, but affordability is still a concern for people. When we look at averaged 5-year fixed, about 4.85% now. That's down from above 6% back at its highs in July 2023. So it's good news that it's down compared to those highs, but it is significantly higher than it was back in 2019. So affordability still remains a concern for many. There is a constraint there. And actually, we've done some work, and you can see here, looking at the number of listings that sort of, if you are on a 4.5 times the mean salary in a region with a 10% deposit, what might that buy you in terms of the amount of what proportion of stock is available to you if you're on single income or dual. And you can see it does differ quite a lot across the country, and there are some regions where for example in London, where it's virtually zero with a single salary when you're looking at the average property price, and about 30% if you're on a dual, and it's different depending on where you are in the country. So affordability remains a concern, and that leads me to my sort of next point when we're talking about price, and we're talking about what people are doing and what vendors are, how they're thinking about the market at the moment. And we've been talking a lot about this throughout the course of the year, that the need to price competitively. The market isn't the same as it was back in 2022, 2023, when it was moving very, very quickly. And we've seen that in a few different ways. One way of looking at that is the proportion of stock that is reduced and the amount of time it's taken to sell. So on the left-hand scale here is the days taking to sell. On the right-hand side, you can see the proportion of stock on Rightmove that has had a reduction. And so that's what this bar chart shows. So you can see that since the end of 2022, we have seen the proportion of stock that has been reduced getting back towards a more normal level. Properties were coming onto Rightmove in 2021, 2022, and they weren't getting reduced. They were just, in fact, lots of properties, as you will know, were going above asking prices. But we sort of saw that reset throughout 2023 as we saw affordability constraints kick in, as we saw mortgage rates reach above 6% for a 5-year fixed. We've seen people people coming on perhaps pricing optimistically rather than competitively, and then having to reduce. And we know that's a concern for vendors, because it means properties take longer to sell. And actually, in fact, it can mean that properties don't sell at all. In the latter part of this year, though, we've headed back towards a more normal level of reduction. So it's about 30% at the moment, which is what we would normally see in a normal market like 2019, for example. And that's, as I say, that's also reflected in the time it's taking to sell. Stock was moving very, very quickly back in 2022. You can see it sort of in somewhere between 30 and 40 days to go from listing to SSTC on average, and it's now in the sort of 60-day range, certainly higher than it was, but a much more normal sort of flow of the market. But I think this demonstrates, with that increased choice, whilst people are wanting to get on with things, transactions are taking place, there is still that need to price competitively. And that all that information, all that's those trends to spill over. And one way of looking at them is asking prices. So we track new seller asking prices through our house price index, which you can go onto our site and see. And this is what it looks like at the moment in terms of year-on-year change. So where are we now compared to where we were a year ago? And you can see that we were in a double-digit growth back in that very fast market of 2022. We saw throughout 2023 the pace of that growth slow as rates were heading upwards. We saw negative growth in asking prices towards the end of last year, and we've seen effectively a sort of sideways move, somewhere between 1-2% price growth year on year, in recent months. So effectively, moving sideways from a pricing perspective. And I think that reflects the fact that transactions are taking place. People are pricing more competitively, but there is more stock out there, and there is more choice. So there is a sort of a need to continue to price competitively in terms of vendors' thought processes at the moment. So I'll come on to expectations for next year in a moment at the end, but I'll quickly move on to the rental market right now. So in the rental market, there is a significant mismatch between supply and demand. I think that's really what's been a key feature of the rental market for a number of years now. This is looking at available listings for rental compared to January 2019. So again, anything below 100 is lower than 2019. You can see we're significantly lower than 2019. At the same time, demand significantly above 2019, and it's no surprise, therefore, that we've seen 30, 40+% increase in rental prices since 2019. So that's really the sort of character. When I ask agents about what they're feeling about the rental market, they say crazy, they say fast, and that continues to be what people are feeding back to me about the market. One of the things, however, despite that, a couple of the trends that are going on, we've been seeing an increasing number of landlords selling up. Now, despite the fact that those prices are moving fast or quickly, despite the fact that there is this mismatch between supply and demand, landlords have concerns around the profitability of letting out property and the concerns around legislation compliance and so on, which is making it significantly more onerous to be a landlord in their minds, and therefore many are reacting by selling up. So this looks at the amount of stock that we see in our sales channel, when the last time we saw it was in the rental channel. So we're assuming therefore that was a rental property that's now been put up for sale, and you can see that has been going up throughout this year. It's now at about 17% or so. Typically it's about 14% overall. It's much higher than that in London, but overall it has been going up, as you can see, in more recent times. And as I say, when we surveyed landlords, it's because of legislation compliance and regulation, and obviously the cost with mortgage rates higher than they were. Now, many of those will be being bought by other landlords, being bought back into the rental market. We know that is happening, but the net flow, when we look at the net number there, is also a negative flow. So I think more going out than coming in at the moment, despite those mismatches in supply and demand. Another point I would mention on supply and demand is that whilst it's significantly higher demand and lower stock compared to where we were in 2019, if we compare to where we were in 2023, we've actually seen demand fall and we've seen more stock coming on. But that is, again, compared to exceptionally low levels of supply and exceptionally high levels of demand. Now, I think that reflects the affordability concerns for many tenants, with prices having moved so quickly and so far in such a short period of time. And they are adapting to how they're looking for property. For example, they're looking further afield to find the next home. They're trying to optimize on price, try and bring that affordability within their own set of constraints. So something to bear in mind, that I think we are seeing this a slight resetting of that supply and demand imbalance, despite the fact that stock might be flowing out and there's lots of demand. It is not quite at the same levels as it was back in 2023. We are, as a result of that, for example, seeing more properties being reduced in the rental market. Still not a lot, still not as high as if you remember, the sales market was about 30%. You can see here that in September 2024, it was about 20% of stock in the rental market was getting a reduction. And so that's higher than it was in 2023. So it's something to bear in mind, that things perhaps are redressing a little bit and starting to rebalance. And those prices are going to be moving a little slower because of that rebalancing of supply and demand. I mean, it's had a little bit of an impact as well on the time it's taken to rent a property. It's still very quick. There's still 19, 20 inquiries per available property, but it's not at the levels that it was back in 2023 in any way. So that then is reflected in price also, as we've seen in the sales market. Those factors and those trends are reflected in price as a sort of useful way to sort of sum up what's going on in the market. So here we're looking at a measure of to advertise rental price year-on-year change, and you can see that it's taken longer to come down from those double-digit growth numbers than the sales market, but it has been falling. So we're now at about sort of the 4%. This is a sort of a UK-wide number. It's different across different regions. London is a little lower than this, and typically we quote sort of a UK ex-London number. This is an all sort of a blended number. It's about 4%, just under 4%, 3.8 or so in November. So we are seeing that number. It's still growing, but it's certainly growing at a slower pace than it was. Something to bear in mind. Just sum up by saying what our next year's market sort of expectations are. So at the moment, as you can see, I think we've seen a market which has gone from a stop-start market in 2023 into a just get on with it in 2024. And I think there are some positives there around leading into 2025, particularly around affordability. So we've seen a sideways movement for many months throughout 2024. We've seen in wages above, that's the house prices. We've seen wages above inflation. We've seen inflation come down. Cost of living is squeezed, certainly still is being felt, but it's certainly less than it was in 2023. And we're starting to see mortgage rates brought on their general downward trend. We would expect further rate cuts from the bank in 2025, and should, in theory, lead, amongst other things, through to mortgage rates coming down from where they are in 2025 as well. Although obviously nothing's certain. So that's what we would expect. So those sort of positives that might support the market in 2025. We obviously also have sort of aspects around stamp duty changes and that sort of incentive that might sort of push people to move in the earlier part of next year, hoping to get in before the end of March. So I think there are reasons for activity. There are reasons for sort of positivity in terms of the market next year, and as such, our forecast is for a plus 4% from our house price index. So that's new set of asking prices by the end of next year. That's just below, I'd say, what an average year would be. That tends to be about 4.7, 4.9. But certainly better than we've seen this year, which we think will end up around plus 1 to plus 2% from a house price perspective. So not running away with things, but certainly more positive in terms of prices next year. And we think also in terms of activity, we think this year will end up with about 1.1 million transactions. I think it'll be more than that next year for the reasons I've just mentioned. The rental market and our price predictions there, I think we're going to come back to that, or publish that quite soon. So I won't give you our rental price predictions just yet. But as you can see, I think we've seen supply edging up a little bit, demand edging down a little bit, still mismatched, but perhaps not the market not moving quite at the same pace as it has done throughout 2022, 2023, and the early parts of 2024. So just to conclude, at the beginning of the year, there were numerous unknowns. We've had them. They've come, they've gone. There'll be more next year, but we've got a number of those big ones out of the way, and people are just wanting to get on with it. And we've seen that reflected in the numbers of transactions that are taking place. We're still seeing an imbalance of supply and demand in the rental market, but it doesn't seem to be at the same levels as 2022, 2023. And we've seen robust levels despite some of those uncertainties of activity, despite some of those uncertainties. So we think those more robust levels of activity will continue into 2025. Challenges remain. Obviously, affordability is still a concern for many, but I think there are some positive signs for activity, certainly through 2025. And as I say, I think we'll see sort of modest average price increases in 2025 as a result. So that's it from me. Hopefully that has been useful and food for thought for 2025. Do get in touch if you have any questions. I think at that point, I will now hand back to Eloise.
Wonderful. Thank you so much, Tim. Some great reflection on the last year. Buy-to-let particularly is something we at Kensington are paying very close attention to, and interesting to hear that there are still between 19 to 20 inquiries per rental property, and although a lower number than last year, it's still a very large number. Seeing kind of a slower pace of growth in rental prices could be probably seen as a welcome change for first-time buyers and an opportunity for this to improve ability to save for deposits. From Tim's insights, it's clear to hear that it's all relative. and it really depends on which year we're comparing this year to. Some data highlighting pre-pandemic levels, and most data giving us a new normal benchmark, which is still growth. Property transactions predicting to be up in 2025, sales prices with a modest and average growth expected. I imagine there will still be some volatility next year, but at much more tolerable levels. Looking to the year ahead today seems much more positive than it did this time last year. And what's clear to see is the resilience of our mortgage market and all those operating within it. So thank you, Tim. Moving on now, next on the agenda, we are reflecting on 2024 and preparing for the year ahead with Mark Arnold, Kensington's CEO and head of Life Moments at Barclays Bank UK. We were very lucky to be joined by Mark, who sat down with Francis Cassidy last week for a Q&A interview. So let's take a look at that video now.
Mark Arnold, thank you very much for joining us today.
Thank you for having me.
CEO of Kensington Mortgages, that's been 7 years now, and head of mortgages, savings and insurance, and that's been 2 years at Barclays.
It's a long time, a lot done. I don't even look old enough, I don't think, but yes.
Absolutely not, absolutely not. And it's been 2 years since the acquisition of Kensington by Barclays. Okay, we've got lots to unpack today, so thank you very much for joining us. If I look back at our last webinar, Simon Betteridge, CFO of Kensington and Barclays, joined us and highlighted some of the 2024 trends. Really interested in what you've seen are the biggest challenges and changes in 2024 are.
Well, 2024 I thought was going to be quite a calm year. So we had an election, we then had a budget, and assumed that we were going to get stability. We'd had 3 or 4 years in a post-trust budget of sort of variability and volatility, and it has calmed to some degree, particularly in the mortgage space with swaps coming down. However, I think sort of the election, the build-up to the election calmed the market, but it also stalled the market. Post-election, the market took off on the mortgage side, and then we get to the budget, and people were hesitant, and confidence went, and we certainly see it in the run-up between budget and Christmas. That confidence seems to have dropped again. So I think we're still going to have volatility, hopefully in a lighter range, but people are still hesitant right now. I hope that will change.
We'll come back to consumer confidence in a bit, actually. And reflecting on the year, what's been the biggest learning for you?
Been many, I think, but I think volatility is the new norm. I think this period of time, certainly earlier in my career, you'd have an event and then you'd have calm for a couple of years. And I think in the last 3-4 years, and certainly last year, there's not been calm. There's constant change in the market. And constant change is good, but you've got to be ready for it. You've got to be resilient. And I think that's certainly what our broker colleagues, community and supporters have seen. They've been resilient. I think we've been resilient in terms of the way that we've approached it as well. So I think uncertainty, volatility, but what that means for us is that we have to be ever-changing and resilient to that.
Brilliant, thank you. So Barclays have recently conducted some research that's been very well received by the trade press. We talked about consumer spending slightly, and we'll come back to that later, but we also talked about right sizing. Could you, for anyone that hasn't read it, tell us what some of the key themes and takeaways are?
I can. I mean, we're conducting, certainly the last couple of years, a lot of research. We have a huge sort of customer base, and we have huge insight, whether it be consumer spending, whether it be sort of on the mortgage space, and trying to lever that to bring added value to customers and brokers alike, and insight. The latest, as you say, is the right sizing report. So we often focus on people getting onto the ladder and the first time buyers.
Absolutely.
But we don't look at people at the top end of the market who are probably similar age to me, sort of 50 plus, who are looking to downside. Maybe the children have left home, the house they need is too big, and looking to step off and step down. And in many ways, they release the market so people can come up through the market. It's a circular effect. So the research was looking at sort of what people think and whether that is true. And it is. 40% of people we interviewed over that age group, and over the age group, not as 60 as you'd think or 55, over 50 and 45, said they wanted to downsize, to take money out of the property or their circumstances to change. And there's nothing there to support them, as there is on the first time buyers. So I think the research stated that, it gave fact and substance to that. And I think it's insightful with the new government coming in to show them that, you know, things that they could do, whether that be on stamp duty, but also supporting them in some of those moving costs and making maybe that tax effective for them to do it as a stimulus to actually get the market moving.
Yeah.
So, and that research is on our website for those that haven't seen it who want to see it.
Absolutely, and we're asked constantly by our brokers and our partners for data and insight and kind of what we're seeing in the market. Like you said, Barclays bank 1 in 4 customers in the UK, so great place to get this from. What do you think the broker benefits are going to be from us doing this type of research?
I think, look, we're one of the few banks in the UK with the broadest range. You mentioned KMC and you mentioned Barclays. We've got a broad range of products and insight, millions of customers, and I think that data, whether it be credit card data, leading to mortgage data, it adds value and fact and substance to some of the things and the trends that they see, but we can provide the fact pattern, and hopefully with the insight that we have, we can affect change. We can share that data with governments, with regulators, to get ahead of some of those trends, and for the regulators, the governments, and the banks and broker community to actually get ahead of some of those trends and support the customers better.
Yeah, brilliant. We've had great feedback from it already, so definitely if you haven't read it already or got a chance, then do so. So next year we're going to be celebrating 2-year anniversary of the Barclays acquisition of Kensington. Time has absolutely flown, hasn't it?
It certainly has.
It has. And how have you found the last 2 years, and what impact has the acquisition had?
I think it's been a pretty, tough 2 years, not just for the acquisition, because the market has been very tough as well, just the volatility that I've talked about. But I think for us as both Barclays and Kensington, I have the unique privilege of actually running both the Barclays mortgage business and the Kensington business, and I think that's really helped as we brought together. So the intent from Barclays was to move into a new space, and the specialist space was an area that they didn't and weren't playing in, but they could support, and some of their customers were in that space as well. So bringing the two brands together, the two independent brands together to serve a broader market has been key. Has it been easy? No, it hasn't. Two very different businesses with very different cultures and different customers in terms of the way that we approach customers. Kensington's more specialist, more hand-holding those customers who are complex, and they're not bad customers, they're complex customers that need time, and we take the time to underwrite. Whereas Barclays is high street, and again, it's speed and efficiency. But I think we've blended well, and we've learned from each other, both research that we can bring to bear, investment. So through some of the difficult times in the last 2 years, we continue to invest in Kensington and to make sure that we're ready for it. And then for Kensington as well, funding, making sure that we had continuity of funding through the cycle and able to support brokers and their customers respectively through. So tough journey with the market, two cultures coming together, but I think we've blended well. I think, and I think there's cross-skilling. There's a lot of people, Francis, you included, who sit on both sides of the camp as I do, and I think that blending of some of the insight from specialist into high street and some of the high street into specialist really is a combination that's winning.
Definitely, and we've got some fantastic people, so it's great to get them involved
Absolutely.
in different parts of the business. So Mark, what's next for the two brands?
Growth. I think with the market, I think 2024 has been an interesting year, but it's been a growth year. It's better than we all expected. I think there is more consistency, and certainly the mortgage market has picked up significantly. It's slowed down a bit, I think, as we run up to the end of the year. I think the two brands are unique, and they have very unique propositions. So the Barclays brand is stable, confident, been around for 334 years, serving customers, and I think it's getting I talk about the efficiency and the consistency with the broker network, and it's also new systems coming in, lots of new front-end systems to support the journeys for customers and brokers alike, and more of that to come in a couple of weeks and also in 25. On the Kensington side, it's growth. We have a parent that is willing to significantly invest in us and it's broadening our proposition. So the resi space and the complex we always occupy, the BTL space that we're growing in now as well. So we've seen significant growth, but where some of our competitors have fallen by the wayside, the investment that we have, the funding that we have, allows us to grow leveraging Barclays. So I think you'll still see the two brands, you'll still see the same people, but more confident and able to support the customers and we're going to continue to evolve. Status quo is not acceptable. So we keep on innovating both in product and service. So more of the same, I think.
Definitely.
But just on steroids.
Absolutely. The buy-to-let prime proposition has gone down extremely well with brokers. I can vouch for that. And hopefully some new innovation coming in the next couple of weeks.
More to come.
Perfect. So Mark, really interested to hear what you think the challenges that are going to face us in 2025.
It's an interesting one. I think we will continue to have volatility. So that's the new norm, as I've said. But I'm positive on 2025. I think we have momentum. So 24 was a better year, much better year than 23. I think 25 will continue on that vein. I think as we run up to the end of the year, it will slow down. It always does. It seems to have slowed a little bit earlier. But I think if you look out to 25, interest rates will come down, maybe a little slower than we thought.
Yeah.
Inflation's spiked a little bit. We've got the next print shortly, but I think interest rates will come down. And the government has set out some huge ambitions on new build. 1.5 million houses, 300,000 a year of new build properties to support demand.
Yeah.
They're also talking about sort of refreshing mortgage guarantee schemes for first-time buyers, and hopefully picking up some of our research on later life as well to support that. So there's definitely momentum and there's a fair wind behind. So I'm generally positive with where the market is going. And I think there's a huge pent-up demand. We've seen that. 22 and 23 were slower for all the reasons that we know with interest rates. There's definitely momentum, both government, market, and buyer. And if you look at some of the listings that have happened, if you look at the estate agents, they're full of listings right now.
Absolutely.
So, and the house price appreciation, the nationwide data recently showed again a healthy increase.
Yeah.
So the market's solid. It just needs confidence, and I think that is the missing ingredient right now. Some of the post-budget sort of noise and news. Let's just hope that Christmas comes, people get some cheer, and that confidence returns. That will be the driver, and I'm positive that it will.
I think there's a lot of optimism for 2025 for sure. Very interesting what you say about new build. The targets, whether achievable or not, kind of not for us to comment on.
No.
However, supporting the new build markets will always been really key for Kensington and for Barclays. And we have an exclusive. So I think it's today, tomorrow, we're announcing that we're supporting the Own You scheme with some of the largest house builders in the UK, which is great news for first-time buyers and second-time buyers.
Another innovative product for Kensington on the marketplace. And again, great news as we come up to the end of the year to get that live and hopefully much utilised as those new builds come through. It's a great product. So it's on the website. Please have a look.
Thank you. So optimism and momentum being some of your favourite words at the moment,
and confidence.
Mark, and confidence. Looking at those positives, what do you think the opportunities for our mortgage market are going to be next year?
I think, and we've talked some of this as well, it's about sort of getting an offering, a compulsive and compelling offering around new build and around first-time buyers. And I think with some governmental support, which I think has been talked about, that's going to help to accelerate. Yeah. I think looking at not later life segment, but that last buy segment in terms of people who want to move down, I think we've got to find some way to support them. And that's certainly the research that we've done and has been picked up by government and industry as a sort of a benchmark. Others have followed in that as well, and it's sort of consistent in terms of feedback. But I think it's service as well, making sure that we continue to deliver as banks, whether it be Barclays, Kensington, or other banks, consistently deliver service levels to customers who want to come through, and that's across the piece. And I think we're going to see technology play a bigger part, I think, in 25 and 26 to improve those services and to give brokers and customers alike greater choice. Yeah, and I think there's more innovation coming from us on the system side, but I know in the market as well, which I think will be helpful. Absolutely.
I mean, I think it was probably about 10 years ago we were talking about robo-advice was kind of the word for brokers and what was going to happen there. Now kind of we're talking about AI and what that might mean for brokers. Should brokers be worried about anything coming up?
I think they should be conscious of it. As I said before, status quo is unacceptable. If you don't do anything, you're going to be left behind. But I think AI is going to be a complement to the journey and a supporter of gathering data and facts, which are sort of bureaucracy, so that brokers can engage more with clients and use the time as added value as opposed to gathering and getting information. I think that's certainly the way we're looking at it. I think over time it will play a bigger part, but right now that's what I see the next 2 or 3 years. It's involving and engaging and learning about it and bringing it into your journeys and processes to support that and support your clients and your speed of decision and or speed of interpretation.
Absolutely. Thank you. Mark, we've got a lot of brokers kind of dialing into this webinar today. Do you have any advice for brokers going into 2025?
Well, first of all, thank you for all your support. You've been a great support for both Barclays and Kensington over the last few years, and I hope you will be for 2025. Support and sort of thinking about sort of advice, I think it's back to that volatility point. It is going to be get ready for more volatility. So whatever happens, be global events, local events, inflation events, I'm hoping that the volatility won't be a range like that, it'll be a range like this, but more volatility. I think engage and embrace technology. We talked about AI. That's going to sort of change. I don't think it's going to be as meaningful initially as people think, but again, utilize it in terms of your journeys. Accept the status quo is not going to be the status quo, and move on beyond that, and get ready for, I think, what will be a 2025 that will be strong, but we'll have to continue both as lenders and brokers to innovate. And remember, as you always do, the customer is king, and that's something we do, but I know you do more as brokers engaging with the customers. Let's work together to sort of get seamless journeys and hopefully faster and right decisions for our customers respectively.
Mark, you've had quite the exciting and successful career. What would be your top tip for anyone who's aspiring to be a leader?
Yeah, I was reflecting on this the other day, 35 years or so in sort of multiple markets around the globe. I think my couple of tips would be, and for those that didn't know, I'd worked for GE around the globe for 20 years, and there was a leader called Jack Welch. He would always say, lean in and take the hardest assignment. You learn more in tough times, in hard jobs, than you do in easy jobs. So my advice for anybody, and particularly in this environment, is lean in, take the hardest assignment. It's tough, you learn, you may fail, but you learn an awful lot about yourself, and the skills that you acquire through tough periods actually put you in good stead for the good periods. And again, the other piece is constantly look at change. Everything you do right now it may be great now, but someone out there in your competition is trying to do better and will land something or launch something that's going to destroy your business. Constantly keep ahead, constantly look to change, and keep a focus on the customer. If you do that, you'll be fine.
Absolutely. Lean in. I'm going to take that away.
Lean in.
Thank you.
No problem.
Mark, thank you so much. That's been really insightful. Really appreciate you spending the time with us today.
No problem at all. Thank you. It's been really, hopefully been useful.
Yeah, absolutely.
And I'd like to also just thank all of our broker community and partners for all the support that they've had, and I think probably wish them a successful and happy and healthy 2025.
Absolutely, and a Merry Christmas.
Thank you.
Back to Eloise.
Wonderful. Thank you so much to Mark and Francis. Mark has a very unique view of the total mortgage market, as his knowledge and insights span both over the specialist lending market and the main street lending market, giving a great understanding of the total UK mortgage market. Mark did mention the Barclays right sizing research, which, if you haven't seen, is available on their website. It's a great read and discusses unlocking the untapped capacity in the housing market, as alongside the government's plans to build 1.5 million properties, it finds that right sizing could be an important part of the solution to the UK's complex housing crisis if properly incentivised. It could unlock a further 3.8 properties into our sector, which is a huge number. But the key words being used in that session is optimism, momentum, and confidence. 2024 has provided us momentum for 2025 to grow and succeed together. And my New Year's resolution will now be as well to lean in. Thank you very much to both Mark and Francis. So next up, we now have our Kensington business updates. As I mentioned earlier, buy-to-let is a key focus for Kensington, and we have recently launched a new product range which offers pay rate lending. Buy-to-let Prime offers greater affordability for your landlord clients, requiring a more simple income ratio of either the higher initial pay rate or 5%. It's available up to 75% LTV and is suitable for landlords, limited companies, and even HMO and multi-unit block properties. We've just launched some exciting specials on Buy-to-let Prime, with most including free valuations, and we're sourcing very competitively on these products, so keep in touch. And also keep an eye on your inbox, as some more specials should be heading your way soon. Francis did mention in the interview that we have recently launched with Own New on their rate reducer product last week. So we are the first specialist lender to support the new build market with this product, and we're really excited to continue to innovate in this space. We're also very proud of our continued commitment to support our intermediaries, offering 48 hours notice on all standard product withdrawals and offering excellent underwriting turnaround times throughout the turbulence of the last 2.5 years. When we look ahead to 2025, Mark mentioned we are focused on growth and keen to work alongside you in that strategy and grow with you. In that spirit, I have a very exciting brand new end of year video to share with you. But just before I do, I want to say thank you to all of our fantastic guests for joining us today. I hope you found it as interesting and informative as I have. When you do exit the webinar today, you'll be presented with a really short survey where you can let me know what you'd like to hear about next. Like today's webinar, it's all based on the back of your feedback, and it really does go a long way. I read every single one of them. On your screen, there is a QR code, so if you haven't registered with Kensington already, please do give that a scan and register with us today. The webinar has been recorded, so if you've missed any moments or want to share this with your colleagues, we will make it available to you later on today as well via email, and it is also going to be available on our YouTube channel. But thank you again to all of you for taking time out of your very busy mornings to listen to us and to listen to this webinar. It is the last webinar before the new year, so if I don't speak to you before, thank you. Thank you so much for your business and your support in 2024. I hope you have a wonderful Christmas break and a very happy and prosperous new year. Take care, speak soon, and here's the video.